Hey, so in the last video I talked about some trading strategies and one of them was pairs trading. In this video we'll dive into currency pair correlations and how you can use them in trading. Welcome to the Olymp Trade channel, a place where you'll always find something that improves your trading. Remember to subscribe. Generally, correlation refers to a relationship between two variables. It can be strong or weak, positive or negative. The prices of oil and the oil company stock have a strong correlation. However, the price of that same stock and the price of steel, for example, will likely be a weak one. Together, Nasdaq and Nasdaq reversal 2x ETF have a negative correlation. That is when one asset goes up while another one goes down. Now, let's look at currencies. Currency pairs with the same base currency will usually have positive correlation. Euro USD usually moves in the same direction as Euro AUD, Euro NZD, Euro JPY. Currency pairs with the same quote currency will also usually have positive correlation. So GBP USD will likely move in the same direction as AUD USD or NZD USD. Applying that same logic, we can safely assume that Euro USD and USD JPY will likely have negative correlation, since USD is the base currency in USD JPY and quote currency in Euro USD. When the USD rises in price, it makes USD JPY go up and Euro USD go down. Central bank policies are a primary factor for currency pairs behavior. That's why it is always better to compare currency pairs with similar central bank policies, such as Euro AUD, Euro NZD, Euro CAD, because monetary policies in Canada, Australia and New Zealand are more or less the same. Now, let's see how you can use currency pair correlation in trading. Let's say you think that the Euro USD pair will go down. In this case, you will open a down trade with Euro USD in Olymp Trade's Forex mode. What if your forecast is wrong? A stop loss would limit the loss, but it would still be a loss. So what do? Find a currency pair with a positive correlation and open a trade in the opposite direction. If your main trade fails, the other one will generate profit. Here is one way you can do that. You open a $100 down trade with Euro USD on Olymp Trade Forex mode and put a 10% stop loss on it, which is equal to 10%. Then you open a rebalancing up trade with GBP USD in FTT mode, so that its $10 potential profit would make up for the potential $10 loss on the Forex trade. If GBP USD provides an 82% profitability, then the winning $10 trade would make the $10 profit. That's exactly how much you need to compensate for the Forex trade's loss. This is exactly what a hedge fund does, opening opposite trades on two assets with a positive correlation. If your forecast on the initial Forex trade is correct, you will get a profit, only it will be lowered by the loss on the FTT trade. If your forecast on the Forex trade is wrong, you will not suffer a loss, because it will be fully compensated by the profit on the FTT trade. As you can see, currency pair correlation can be very useful for making a profit and hedging against losses. Olymp Trade will be sharing more trading tricks in the coming videos. So remember to subscribe and press the bell button. See you!